In today's episode, I'm going to teach you how to read candlestick charts the right way. And the first thing I'm going to tell you is going to come as a shock. I want you to stop using technical indicators. Not forever, but for right now. And here's the reason. A lot of beginner traders rely on technical indicators in hopes that those indicators will give them a buy signal and a sell signal, red light, green light, to make trading very simple. And while I understand the desire to simplify something as complex and as difficult to master as trading, indicators are not the solution. Here's the problem with technical indicators. A technical indicator takes all the data that's in the candlestick chart and it converts that data into essentially a signal, which is either positive or negative, or sometimes it's oscillating. The problem is that that calculation ends up leaving a lot of the data of the candlestick chart lost. And so I would say that there's a lot that's lost in translation between the raw source of data and the output of that technical indicator. So what I'm going to teach you how to do is I'm going to teach you how to actually read those candlestick charts so you can go direct to the source. By doing that, you will have one jump ahead of all the traders using technical indicators, and here's why. Technical indicators, because they're relying on this data from the charts, are always lagging slightly behind the chart. The data needs to close before the calculation can occur and the indicator can give you the buy or sell signal. So if you're using the raw data, you will be a faster trader. And the first trader to spot a breakout will be the one who makes the most money. The first trader who can get out before the stock rolls over will capture the most profit from the move. And I want that to be you. So let's begin by jumping onto the screen share and looking at this example right here of what I call a micro pullback. This is going to give you a little bit of motivation for what we're going to be working on learning today. This is an example of a stock that squeezed up, as you can see, from about $2 a share down on the low end all the way up to over $9 a share. This was on breaking news, and I was able to produce a profit on this stock alone of over $73,000. I should probably remind you, my results are not typical. I've been doing this for a long time, and for those of you guys tuning in perhaps for the first time, you already know we're about to jump into a deep dive class. We've got a lot to cover here, but let me briefly introduce myself. My name is Ross Cameron. I'm a full-time trader, and I funded my first account in 2001. As of today, I have produced in excess of $20 million of gross profit in my trading career, and I created this YouTube channel right here in January of 2013 to document my process of what it really takes to become a consistently profitable trader. So let's go ahead and jump back into this. Right here, we've got this example of this stock moving higher, and this is a candlestick chart. Candlestick charts are actually hundreds of years old. They were originally created in Japan to track the price of rice futures. So each one of these shapes right here is an individual candlestick. An individual candlestick represents a period of time. So charts represent either 1 minute chart, 5 minute chart, daily charts, and whatever the time frame is, each candlestick will correspond to that time frame, which means that candlestick will be all of the price action that occurred within that time frame. So if it's a daily chart, then each one of these candlesticks represents the price action that occurred during that entire day. If it's a 1 minute chart, each one of these candlesticks is only 1 minute of price action. But each of these candlesticks communicate sentiment in the market. And this is where I actually get my buy and sell signals from. So if we look right here, if we zoom in on this candle is actually an indicator of a reversal. You might not recognize it yet, but you will by the end of today's class. And so while this candle indicated a possible reversal, as the stock sold off right here on this one red candle, it then rallied right back up and made a new high. So here was a sell signal, and right here was a buy signal, almost back to back. And these are the signals that I want you to learn how to spot in real time. So I'm going to begin by teaching you the anatomy of each of these individual candlestick shapes. I would consider these to be like letters of the alphabet, and there are maybe 10 to 15 individual letters that I'm going to teach you today. These letters form together to create words, and the words that I'm reading are buy or sell. And this is far better than using a technical indicator. This is the raw source of data. So each of these candlesticks are created with 4 pieces of information. We've got, I'll draw a candlestick shape right here. In this case, we've got, and I'll do 2 little lines. The 4 pieces of information include the open, which is the bottom of the candlestick body. This right here is the body, and these are the upper wicks and the lower wicks. So the open is the bottom of the candlestick body. So if we look at our candlestick chart right here, this is the bottom of the body, and then this is the top of the body. So that right there is the closing price. And then right here we have our high of the period, and right here we have our low of the period. So this is the open, the close, the high, and the low. Those are 4 pieces of information that every candlestick has. Those 4 pieces of data are what create the shape of the candle. Now in the case of a red candle opens at the top and closes at the bottom. So that's the only difference. The open and the close are switched, but the low is the same and the high would be the same from that candle wick. So it's important that our candles are colored based on whether they're going up or going down, because then we can understand that the open is at the top and the close is at the bottom in the case of a red candle going down, or that the open is at the bottom and the close is at the top in the case of a green candle that's going up. Now, for folks that have difficulty seeing or are colorblind, they don't necessarily have to be red or green. They could be shaded, and then this one would be hollow. Most charting platforms actually give you a fair amount of ability to customize your charts to your liking. So if you needed to modify it a little bit, that would be fine. But for what most traders do, it's green is going up and red is going down. Okay. So in this case right here, this move begins at about 8 a.m. We can see the time on the chart right down here. This is 8:01. So this news came out at 8 a.m. Now, you may not know this yet, but my strategy is based entirely around trading the volatility that is the result of a stock having breaking news. Candlestick charts and the language of technical analysis that you're learning here today can be applied to any financial instrument, stocks, futures, cryptocurrency, it doesn't matter. I choose to apply it to trading stocks, and specifically smaller cap, lower price stocks that have the potential, as you can see here, to go up 200, 300, 400% or more in a single day when they have news. And these are stocks that typically trade on millions of shares of volume after that news first comes out. So what we have here was a breaking news event, and this first candle, which is green. So this candle opened at the bottom, and because it doesn't have a lower candle wick, it means the price never went down. So we open down here, and immediately the price goes higher, and we close at the top. There is no upper candle wick, there is no lower candle wick. In both cases, that would be less than desirable, because the lower candle wick would show that at some point during this time frame, and let's just say it's 1 minute for the sake of argument, that the price dropped before rallying back up. That would show that there was some weakness, but that's not the case here. In this case, the price opened, it immediately squeezed up, and it closed at the very top, which makes this a very bullish candle. However, the next candle opens at about the same price that the previous candle closed and continues higher. And so you have a second candle, and the second candle is even bigger than the first candle. So each of these candles right here are very bullish, and especially because of the context of them occurring one candle after the other. So what if we had a different scenario? For instance, what if we had a chart where the first candle was really big like this, and then the second candle was smaller, the third one was smaller, and the third one was smaller even yet? What is this communicating? Well, I think this tells us that the trend is becoming exhausted, and we might worry about a red candle coming in. So that should be a reminder that candlesticks, the individual letter, so to speak, the individual candlestick shape is important, but context is also probably more important. So here's something that I'll share with you. When you're trying to read candlestick chart patterns, if the price is going sideways, as it is right here, these patterns and these individual shapes don't carry a lot of meaning. Why is that? Well, the fact that the price is going sideways already communicates there's sort of an even tug of war between buyers and sellers. The areas where I get really interested in candlestick shapes is when we have a stock, or again, it could be a commodity, it could be a Forex currency pair or a cryptocurrency, but when the price is trending very strongly, because this is where I get worried about a reversal and I need to get out before that happens, or where I'm looking for my opportunity to buy something that is strong for that next leg higher. So what I'm going to do is I'm actually going to show you guys here a candlestick pattern reference guide that you guys can utilize. I'm going to put a link and I'm going to pin it to the top of the comments, and it'll be linked in the description, and you guys can download this PDF resource for free and you can utilize it in your own trading. In today's class, I'm going to teach you 11 unique individual candlestick shapes. Those are the 11 so-called letters of the alphabet. Now, those letters are then going to form these multi-candlestick patterns that are on this guide right here. These are the patterns that I'm looking for that give me the buy and sell signals. So rather than relying on the interpretation of a technical indicator, I would rather get my data straight from the source, which is the candlestick chart. So make sure you guys download this reference pattern guide. You can print it out and then you can utilize it and reference it as you need to. So let's begin going through these 11 candlestick shapes. The first one right here is called a small body candle. And then the second one right here is a large body candle. So a small body candle could be red or it could be green, but it has a smaller body, and a large body candle, as the name implies, has a larger body. So therefore, this is, I'm going to do a plus for bullish, and this is super bullish. This right here is bearish, and this right here is super bearish. So bullish is positive, bearish is negative or weakness. So these are our first two individual candlestick shapes. Okay, so in this chart right here, in this example, we see what you could argue maybe is a small body candle there, and then the first long-ish body candle, and then a really long body candle, and then the trend starts to get exhausted as we have a slightly smaller body here. Even though this is still a pretty nice candle, it's smaller than the previous one, and context is everything. Now, if you look down at the volume bars, you would still see that volume is growing, which is good, even on this candle, but the candle's total size is smaller. So then this candle right here in the middle, this is called a doji. Okay, so this is our newest candle that I'm going to introduce to you. I'm going to flip back over on this side. So the doji is a candle that opens and closes at nearly the same price. Sometimes it has a small body that's green, sometimes it has a small body that's red. But what's important is that they open and close at about the same price. But during this period, which let's just say this is a 1 minute period, so during these 60 seconds, the price opened, the stock dropped down, then it rallied back up, and then it came back down to close at more or less the same price. So what is happening inside this candle? It's a tug of war. It's a battle between the buyers and the sellers. Who's going to win? Will it be the sellers? Does the candle close red? Or will it be the buyers and the candle closes green? And at the end, they're kind of at a truce, and you've just got this huge whip in price action. So this right here is a giant warning sign, right? This is where I put up the caution flag. If I see this, I'm worried. But wait a second, context is everything. So if I see that doji candle, but the price is already going sideways, well, we already have indecisive price action. So in that case, it's actually not that big a deal. But if you've had 2 or 3 long body candles in a row, and then you see this candlestick of the doji, which signifies this battle between buyers and sellers, that right there is a signal that the trend may be exhausted and we may have a reversal. The confirmation will be if the next candle goes lower. Now in this case, the next candle is red, but it doesn't go lower. But let's talk a little bit more about the doji before we get into that next candle. So there's a couple different variations of the doji. The first variation is when the open and close is at basically the same price. So this is going to be called a standard doji candle. Now, if you have a doji and you have really long candle wicks, this is called a long-legged doji. All right, so it's got kind of a funny name. Then if you have a doji that looks like this, it opens and closes at the same price, but it has only an upper candle wick. This is called a gravestone doji. It's an ominous name, and it communicates weakness. Because what happened? The price opened, it squeezed up, and then sellers pulled it all the way back down. And then I'll draw the next one on this side. This is called a dragonfly doji. So a dragonfly doji takes flight. So while this is not ideal, that the price opened and closed at the same level, it sold off, which was weak, but then it rallied back up. So by the end of the candlestick period, who won? Well, the bulls won the battle because they defended these lows and the price rallied back up. So if we have a doji, generally speaking, dojis are considered to be neutral. So we've got a standard doji, a long-legged doji, we've got a gravestone doji, which is going to be on the more bearish side, and we have a dragonfly doji, which is on the slightly more bullish side. So here's a tip that I'm going to share with you. Pay really close attention to candle wicks. Yes, we want to see candles that have nice large bodies, like this, but if we see a candle that has a large body like that, but it has a huge upper candle wick, what does that tell us? That communicates weakness, that line right there. On the flip side, if we have a lower candle wick, that shows that while the price sold off, the buyers rallied it back up. So remember this. So anytime we have a lower candle wick like this, it is bullish. Anytime we have an upper candle wick like this, it is bearish. Just remember that. Upper candle wicks are bearish, lower candle wicks are bullish. Okay, so now let's talk about the next candlestick shape. So in this context, again, we've got the price that's rallied up. We've got a couple nice, big, long body candles. And our first potential reversal indicator was a doji, right? We have a doji. That's a very common reversal indicator. The next candle opens at about the same price as the close. And if this drops back down right here, then we're selling off. And that's what happened on this chart. We drop back down on the next candle. However, what does that candle have at the very bottom? It has a bottom candle wick. So what it shows us is that while the price sold off, by the end of the candle, the buyers had rallied it back up. So yes, we had a little bottoming tail there, but then it rallied back up. The next candle opened at approximately the close price. Red candles closed lower. It opened here and it rallies up here. And in this moment, that candle was very bullish because it broke the high of the previous candle. But let's talk about that red candle right there. That red candle has a name. It's called a hammer. See how it actually looks like a mallet? And it's because of that bottoming tail. If it was just a long body red candle, it's not a hammer. It's only a hammer because it has the bottoming tail right there. And so it's considered to be hammering out the base. So hammering out the base, mallet like that. So the low of this candle wick, the psychology is that it's hammering out the base, and this is support. The stock sold off, but buyers came in and rallied it back up. So a hammer, therefore, whether it is red or green, is bullish because of the bottom tail. This is more bullish right here if the candle is green. So we have this bullish candle, and then what would be confirmation that the reversal is occurring? We sold off. The confirmation of the price going down here was the doji, and then this candle breaking the low of that doji. So we had what's called a candle under candle pattern. When you have one candle, and we'll just do it like this, you have one candle here, and then the next candle opens and breaks the low. That's called candle under candle. So this candle broke under the low of that candle. A candle under candle, and we'll just do this right here. So candle under candle is bearish. Candle over candle right here is bullish. And that's what we ended up getting right here. First, we got a candle under candle. Then we got a candle over candle. All right. So candle over candle is bullish. And so that right there becomes this candle or confirmation. And what's the price that I would enter? typically I would enter the moment this green candle broke the high of that candle right there. The second it breaks, I'm a buyer. So if the high of this candle, for instance, is $4.25, then I'm already watching that level. And I'm looking for the second the price breaks $4.25. And so when I'm actually looking at my market data, which I'm using my trading software to do, and I see it's at 419, 420, 421, 422, 423, 424, and I'm seeing the price moving up, I know 425 is the signal. And so now I'm at straight raw data. The second I see 425, I send my buy order and I'm in. If you were waiting for your technical indicator to give you the signal, you wouldn't get it till this candle green closes. And if this thing goes up to 450 right here, well, you're now getting in 25 cents higher than me. In fact, I might even be taking profit already. Maybe not. It depends on the circumstance of how much I think it can go up. In this case right here, this little pullback right here resulted in the stock going from about $6.20 all the way up to $7, and then all the way up to $8, $8.50, all the way up to almost $9 a share before it pulled back again. Wow, that was a huge opportunity. And if you were waiting for your indicators, you would have missed it. Okay, so the hammer is a very important candlestick. We like to see the hammer. Hammers are hammering out the base. However, there's another candlestick shape that we should discuss. We call it a shooting star, and it is negative. All right, so if here in this context, instead of a doji, let's just say for the sake of argument, the price here opened, it squeezes up a little bit, creates that topping tail, and then comes down and closes red. That candle right there turns red, the whole candle turns red, and that's called a shooting star. Shooting stars come back to earth. Shooting stars drop. And so what this shows us is, again, look at that topping tail. The topping tail is the weakness. So we have that topping tail, then the candle drops back down, and the next candle opens, and it goes lower. In fact, when you have a red shooting star, the reversal, truthfully, has already begun. Even before this 1 minute period, if this was a 1 minute chart, closes, we can already see the reversal has begun. The second that the price came back down, we opened, we went up for a second and we were green, and then when we came back down, the second this candle went red, I didn't even need to wait any longer. I've already got my exit indicator the second it goes red, because this opens at the low and the next candle almost always continues lower. And then this is the beginning of a pullback. Now let's just say we base out there with our hammer candle, right? And then what do we look for? Our candle over candle formation and a rally back up to the high. And then we come back up, we get a doji pattern. Then we get a candle that drops back down, small body candle, a little doji right there, let's say, then a little small body candle and a rally back up. And so the areas where I'm paying the most attention are at potential pivots, where the price is potentially going to reverse down or reverse from down back to up, and then from up back to down, from down back to up. These are the most essential candles that I use every single day while I'm trading. Short body, long body, the dragonfly doji, the gravestone doji, the hammer, the shooting star, the candle over candle patterns, and then these dojis right here. These are the ones that you will see me using in my trading almost every single day, but again, focusing specifically on the apex points or these pivots. Now, I'll tell you right now, this is just the beginning. We're scratching the surface. But exactly what I want to do here is introduce to you this language of technical analysis. It truly is the language of the financial markets, and is a universal language that you can apply to any financial instrument. So if you want to keep digging deeper, make sure you guys download my full reference guide. It's a free PDF. And if you want to do a 2-week trial, where you actually watch over my shoulder while I'm trading every single day, I'll put a link to that in the description as well. It's $20 for 2 weeks, and not only can you watch me as I'm trading, you'll have access to a selection of classes that goes deeper. Because one of the things that we end up using is what's called level 2 market data. Level 2 market data are the actual quotes of buyers and sellers, and when orders go through, those are what then populate on our candlestick charts. So while no doubt candlestick charts are the data source that technical indicators use, level 2 data is the data source that candlestick charts use. Wow, there's a lot more to learn. If you guys enjoyed this episode, I hope you hit that thumbs up. I hope you are subscribed to the channel. And if you want to learn how to trade more stocks like this, make sure you check out the 2-week trial in the link posted in the description down below. All right, I will see you for the next upload real soon. Reminder, as always, trading is risky. My results aren't typical, so I want you to manage your risk, take it slow, and always practice in a simulator before you ever put real money on the line.